U.S. job creation started 2026 on a softer footing than many economists expected. And according to the ADP National Employment Report, private employers added far fewer jobs than forecast in January, raising questions about the labor market strength and what it could mean ahead of the official jobs numbers. Reports showing U.S. private payrolls increased by just 22,000 jobs in January, well below the 48,000 positions economists had expected for the month. That's also less than December's revised gain of 37,000 jobs. Despite the modest headline number, wage growth held steady, with annual pay for workers who stayed in their jobs up about 4.5% year on year. Job gains were concentrated in a few areas. Education and health services led with more than 74,000 jobs, followed by financial activities and construction. In fact, these were more than offset by steep declines in other sectors. Professional and business services shed 57,000 jobs, while manufacturing lost about 8,000 positions in January. Economists say this fits a low-hire, low-fire labor market where companies are cautious about expanding payrolls even as unemployment stays relatively low. And this comes as the official January jobs report from the Bureau of Labor Statistics has been delayed because of a partial government shutdown that just ended. So analysts are watching this ADP data for signs of the broader trend. With hiring softer than expected, markets are taking note. Investors and policymakers alike will be watching the full BLS jobs report closely once it's released for a clearer picture of the overall U.S. labor market. The United States, the European Union and Japan are stepping up coordination to secure critical mineral supply chains, signaling a major shift in global trade and industrial policy. The meeting in Washington, officials announced action plans and new partnerships aimed at reducing vulnerabilities in minerals essential for advanced manufacturing, defense and clean energy. In Washington, the United States, the European Union and Japan agreed to accelerate cooperation to strengthen supply chains that have been exposed to disruptions and economic coercion. The partners say years of non-market practices have left market-oriented economies overly dependent on concentrated sources of supply, making critical minerals a growing economic and security risk. And as a first step, the United States and the European Union plan to conclude a memorandum of understanding within 30 days. The agreement will focus on supporting mining, refining, processing, and recycling projects, while also promoting research, innovation, stockpiling, cooperation, and measures to prevent supply disruptions. The three partners also plan to develop action plans that could form the basis of a binding plurilateral agreement on critical minerals trade with like-minded countries. And among the measures under consideration are coordinated trade policies like border-adjusted price floors, standards-based markets price gap subsidies, and long-term offtake agreements. U.S. Trade Representative, meanwhile, said the initiative marks a new paradigm for preferential trade in critical minerals and sends a clear signal that major market economies are acting together. The United States and Mexico have also enacted a first-of-its-kind action plan that includes identifying priority minerals, coordinating geological mapping, supporting responsible mining and processing projects, and exploring price floor mechanisms. Officials say future discussions will continue in forums such as the G7 and the Mineral Security Partnership as governments seek to build more resilient and transparent supply chains. With demand for critical minerals rising rapidly, this coordinated push also marks a strategic turn in global trade policy.